Hey everyone, today I'm going to give you a nice introduction on stocks and stock trading. My name is Day Trader Rockstar. That's what they call me on my radio show at daytradingradio.com, where I each and every day teach you about the stock market, more specifically how to trade the market. Now this might be brand new to you. You might be in school, you've never had an interest in the market. This is hopefully we're going to have a nice little series of videos that kind of introduce you to the market, what it's about, and some of the basics of trading. All right, there's a tremendous history with the market, and there's a lot of information on the internet. You definitely worth checking that out and follow the history back of why we have the markets and stuff. I want to get more into the technicals and how the market works and how you could actually trade and be a trader in the market. Just starting off, looking at a chart, and this is what this is you're looking at here. And again, we're going to start on some basics here. Looking at this, you might not even know what you're looking at. Basically what this is it's called a stock chart, and it really tracks the most movement of the stock that it's tracking. In this case, it's Ford, and Ford is a very popular car company. And the car company has stock, and the the symbol is F, and you can actually follow and track how the stock has been performing. And take it even on a more basic level, just remember that many companies have their own shares out in the public, where people like you and me can actually own part of the company. They're publicly traded companies. Ford, Disney, you name it, basically name it. If it's big enough, it's probably traded in the stock market, and you can actually probably be an owner on a small level by owning some of the stock. Now what people like to do is actually take this stock and trade it, meaning they buy it at one level and they sell it at another level and they keep the profit. And that's what the markets are. The markets are a market, just like any other market. You go in to buy something. So the markets are where these publicly traded companies, Exxon, you name it, like I said, IBM, Apple, computer, these are where their shares are on the open market, and people buy and sell them based on what they feel the value is. So when you do see that, you actually see a chart that's left over. It's just a little map, a historical map of what happened with this chart. And this Ford, you can actually see it just was up here. It came down in the most basic sense and then started pushing back up. Well, what does that really mean? What does each one of these bars mean? Each one of these bars represents 1 day of movement in the stock price, and you can see over here it says 1042. It's $10.42 as of today when it closed, and that's how much one share would cost. But maybe throughout the day it would actually went up to 1070 and came down to 1030. So you had this 40-cent range throughout the day, and it actually forms a candle. And really that candle is as big as the range of the day. And there's other aspects of the candle we're going to go into on more detailed videos. But basically each candle in this chart, being a daily chart, represents the range of the stock in that particular time frame. Now there's different time frames that you can use. Daily means it's throughout the whole day. You could use a 5-minute bar or time frame, and each candlestick would represent 5 minutes time. And here it is, like that. But again, we're going to just look at the basic underlying factors of charts and why they move, and the daily is going to be a fine one to look off of that. So that's what you're actually seeing right now. But how do you start to predict, and how do you know that the stock is actually going to make a move from here to here? Or where should you buy and where should you sell, and how does that all come in? Just looking at a chart like this, unless you really knew the company or you worked there, or felt like you knew something better about what you're looking at, you have really no clue what you're looking at here. So that's why a lot of traders, we learn the basic and the fundamentals and the good foundation. We learn what a trend is. We learn support and resistance lines, and you learn something about averages. And these are the three topics I want to cover today. These are three important topics that you can learn. Basically, the first one, really important, is determining what type of trend you have. And a trend is basically when something's trending, it happens in a row over a period of time. And meaning there's two type of trends we can have here. We can have a downward trend, or we can have an upward trend. And that's usually over a period of time we start to recognize that the price level here is moving down. So we have a downward trend happening until finally we break that downward trend, and now we have this kind of upward trend moving, and it's going to move in pieces, but again, that could be broken down and learned. But the important thing is recognizing how to recognize trends, and trends are just basically a line, connecting two pivot areas. And again, a pivot area is really an area where the market might move up to a level and then pull back, or move down to a level and push up, and it leaves a little angle there. It leaves a corner, and that corner represents a pivot. So every time a market comes down and bounces or pushes up and pulls back, it leaves a pivot area. And from those pivots, you just draw a line. And if that line is pointing down, then the trend is down. If the line is actually, pointing up, then the trend is up. And that's the basics of, just following the trend and understanding where the trend is. Here we have a chart of the S&P 500 index, and this is really the group of stocks that are traded in the S&P, what we call the S&P 500 stocks, and this is the average of those. And it could be traded just like anything else, but I just want to show you as a basic chart the directional, how the market is moving. And again, understanding trends, you could just, another example of a trend, basically you're taking a pivot area. There's multiple pivot areas here. Here's a pivot area, here's a pivot area, here's a pivot area. And even on the upside, there's a pivot area here, pivot area here, and they're very closely bound up. But basically, you're going to try to connect those pivot areas. And in this case, you could actually put it up to there and stuff. It doesn't really matter as long as you're catching the bottom part. You're going to get used to looking at price action and see that there's what we have as a trend. And what the trend means is each time we pull back a little, we push a little bit higher. We pull back, we push a little bit higher. We pull back, we push a little bit higher. So as long as your trend line represents that, and you're picking up the trend line on the lowest pullback here, you got one part of the formula there. The second part of the formula is understanding where that trend pushes up to. So each time we get a move up, we run into a level where we pull back to the trend line. We move up and we possibly pull back to the trend line. We move up and pull back to the trend line, and that's how you develop and get strength on that trend. And each time that trend is touched, it gets tested and becomes a little bit stronger, and each time it comes down, you can actually take a trade off of that. But there's also another side of the trend, and that's where the stock is going each time it pushes up. And we see that there's a pivot area here versus here versus here. You draw that trend line in here. Now you have two channel lines or trend lines, and that really represents a channel that the stock is traded in. So just by learning where the trend is, you could develop a couple different trend lines. That really represents a channel, and then from that channel, you're actually breaking down the stock movement and actually seeing on a tighter, a smaller time frame, that you could actually see the market move from here to here, then it moves back down to here, and we're starting to track it a little bit better and understanding. And because we know where it is, we know that up here now, there's probably a good chance of the stock reacting off of this level right here, because it did here, it did almost here, it did, and so right here it makes a good argument to look for the stock to actually move down. And again, you could actually maybe even profit off of that by knowing which direction the market wants to move based off of these trend lines. So it's very important, a very basic thing. Most charts will form a trend. All you have to do is connect the pivots. Some trends last longer than others, but once you recognize them, and you have an opportunity to trade off of them. These are giving you what I call the highest probability trade areas in a chart. I hope I'm not getting too far ahead, and I wish I could take questions. But remember, trend lines, you develop, you make those trend lines off of pivot areas. You need two pivot points to make that extension, that line, and that line will go up, and each time a price will come up to that line, there's a possibility of a reactionary trade back down. And then from the downside, you're starting to put in a trend line underneath, connecting the pivot areas, and you see the directional trade. So that's very important. Trends and how to identify trends and how to make trends. This leads to figuring out what kind of channel it is, and from that point on, you could actually, start to read the map a little bit better. So the next topic I'm going to go into is actually support and resistance. This next section, we're going to be talking about moving averages. And moving averages are an indicator that kind of tracks the history of a stock price each time frame. So if we're looking at the daily chart right now, and each candlestick really represents 1 day's action. And then the moving average that we place on this chart, and the moving average, I'm going to show you how you do that. Again, that moving average is going to represent the average of these daily bars. Alright, the next section we're going to talk about is moving averages. You might hear this term, maybe not. It's definitely related to stocks and the stock market. A moving average really tracks the price history. Each candlestick right now on the daily represents the range of the day. Say, we're looking at the S&P, went from like 1305 to 1325, so it had a range of 20 points. Well, that's what that candlestick measures. A moving average pretty much measures the price over a time frame. So normally the most active and more popular moving averages are the 20-period moving average, the 50-period moving average, and the 200-period moving average. And just like it sounds, the 20-period moving average, or the 20-day moving average, if you're looking at it on a daily chart, represents the past 20 days, and those prices all added up and divided, and it gives you an average, and that average is exactly where that line is plotted. So you kind of get an average of the price over the last 20 days, and if it was over the last 50 days, it would put a different line in. That would be the 50-period moving average, and the same thing for the last 200 days. You take each one of these candlesticks, you add up the price, the closing price, you divide it by how many days, and that would give you the average. So each day, the average moving average line would go up with the price. I want to put these moving averages in right now. They're called they're my overlays, and I'm going to add on to my chart. And we're going to start. I'm just going to use the standard 20. All right, apply, and you can see how that one just plotted itself right under there. All right, so we're going to just start off with the 20-period moving average. I'll put one more on there. I'll put the 50 on there too, and then we'll worry about the 200 another day. So here's the 50, apply it, and the 50 is in light green, and you can see because the longer the time frame, the more that moving average is staying away from the price level right now. The quicker one, the 20-period moving average, stays closer to the price. But one thing you can notice now that you see two moving averages here, especially the 20-period moving average, which is very valuable, is a couple things that you can look at. Lots of times the stock that moves away from the average comes back to the average. If it moves away from the average, comes back. So it's always looking for its mean or medium area. And when we're able to recognize a channel and put that moving average in there, all of a sudden we're looking at two different things that kind of help us guess the direction of the market. Lots of times a moving average could be used as support, and support, it means that a price level will come down. That moving average is such a known entity in the market that other people see that, and you have this kind of self-fulfilling price level being held up by this invisible average. You know where it is, and everyone else knows where it is, but it's placed there, but it's not a real tangible thing. And yet the price actually holds this, and we pop off of it and continue to move up to the top part of that channel line. So there's definitely argument that the price is going to come back down eventually to that 20-period moving average, and you could also trade off of those scenarios. So that's your 20-period moving average. It kind of just represents the average of the past 20 days plotted on the line. The line is then plotted, and it just overlays the chart action. And lots of times you'll see that that 20-period moving average continues to be tested by the price. The price will move away, it'll pull up to it, it'll push away from it, pull back to it, and back and forth. And then the 50-period moving average is another average, a little stronger than the 200, which will be plotted down here, is even stronger than that. And those act the same way, and sometimes they're even stronger because they have more what we call data behind them, 50 days versus 20 days, or 200 days versus 50 days. That would make it a stronger average. So that's a concept of basic concept of a moving average. You could use moving averages to trade off of. You can use moving averages to actually see the trend. It's basically is the average moving up or the average moving down. It's a very highly reliable and easy to follow indicator. So the combination of knowing your channels, your trend lines, and your moving averages are giving you a little more detail of how this chart is working out. Alright, this next section we're going to concentrate on a topic called support and resistance. And support and resistance is two important terms in the market. It really represents more of the history of the previous price action. When a stock moves up to a certain level and pulls back, or pulls down to a certain level and bounces. Each time that does something like that, again we start putting those pivot areas. That's one thing that's identified as a pivot area. But also, if we look, each one of these levels becomes a level in the history of the stock, and when those levels start to add up, then we start to say, well, there's more weight to this average. There's more weight to this level, because right now we're starting to develop a kind of a series of tops here, and this really develops what we call resistance. So we're trying to push through this, but each time we get up to that level, we push back. And the same thing on the bottom part. If you actually see an area, here's an area back here, we have a nice pivot. I look forward, I actually see that we kind of gap down, and then we pushed higher, and we start to actually react off of this level multiple times. We reacted here, we reacted here. We came up to it here, and then we broke out of it, then we came here. It makes sense now that this is really starting to develop its support level, and it has to be tested a few times really to take hold. Just because it went there once doesn't mean it's that. There is a little chance of a little resistance, getting up to that level, but until we actually put another point of interest there compared to that one, then this one becomes a more reliable one. If it's just this one, I wouldn't just count on that alone, because any pattern can play out. But once you have two or more, then the third and fourth one become more viable areas to look for a reaction off of that. And you can see here, we came back down to this level and we actually bounced. And that's, the basics of the support and resistance. Just understanding that levels that were once tested and they get tested again and they hold up become more actively important further on in the chart. As you get to that level again, you can actually take a trade off of that. So that's an important concept in the overall chart. So today, on this introductory video, I hope it wasn't too complicated. Maybe it was. Basically we learned about trends and how to recognize a trend with a trend line. And sometimes you can put two trend lines and really represent that channel and see the space between that channel really is a trading range. The moving averages are really track the historical price of the stock that you're tracking for the past 20, 50, or 200 days, depending on what your average is. And then we have support and resistance, which really represents different pivot areas, which we learned about. The pivot areas are just the market making a move from up down or down up. And from these levels, you could really develop trend lines, you could develop support resistance lines, and you would develop the patterns as the channel would be the first pattern you should learn. And that's just represented by just an equal distance between two pivot areas all the way down the chart. And from these levels, you start to react, and you can actually build and trade off of these levels. And that's the basics of trading, and that's really a topic we call technical analysis, chart reading. There's other parts of trading that gets more involved, the fundamental aspect of it, being able to understand a balance sheet and making sure the company is a good company to invest in, and that's all important and stuff. But this is basically reading the chart, trading, on a more longer term, a shorter term time frame. Longer term would be really considered investing, and you've probably heard you've heard people talk about investing in the market, going in there long term, putting your money in there to work for it. In this environment these days, the market's very volatile, and you're more apt to make better money if you're able to capture the smaller moves versus waiting and putting your money in here and taking it out here and not seeing that move, being able to profit from here to here, back down to here, back to here. Not going to happen that way, but it gives you a lot more opportunities to trade a shorter term time frame using technical analysis than you do other ways of making money in the markets. Okay, well, that's it for today's video. Hopefully this is a good beginner video. And my name is Day Trader Rockstar, and I'm a DJ at DayTradingRadio.com, where I do this each and every day. Hope you enjoy this video, and I'll talk to you soon.